welcome to the latest edition of Behind the Charts. I'm Dave Keller here at StockCharts.com. On Behind the Charts, we focus on the stories behind the charts and really the personalities behind the charts, learning from the top technical analysts in the industry, learning about their experiences, the formative years as they get started in the industry. Today, we're sitting down with Dave Lundgren. Dave is a longtime money manager, actually, and is one of the few money managers who explicitly talk about technical analysis as their main input. David's career has been pretty impressive. He's spent time at some of the largest buy-side institutions in the world, places like Fidelity Investments, Wellington. He had time at a number of hedge funds, but also some formative years at some technical research shops, technical data shops. What I love is he talked about his early career, his first job. He was called the updater. His job was to update charts, and look at how his trajectory has evolved. He will share with you some of the lessons learned from a career spent managing money using charts. Here's my conversation with David Lundgren. So, Dave Lundgren, it's awesome to sit down with you. Thanks for joining us today.
My pleasure, Dave. Great to see you. Thanks for inviting me.
It's good to see you too. And I miss the times when we were geographically a lot closer and able to see each other much more often. But for now, we'll deal with doing it virtually. But I hope things are good in Boston.
Things are good. Things are busy.
Yeah.
Keeping busy. Yeah.
Believe it. Good. So Start us for this. I'm excited to share your story because I think you've hit on, you've practiced technical analysis in a lot of different roles at a lot of different types of firms. And I think that's a great story for people to hear. But start us at the very beginning. Where are you from originally?
I'm originally from a place called Sutton, Massachusetts, which is just outside of Worcester.
Okay.
And Worcester has the dubious honor of having been the city in the country whose real estate market went down the most in the global financial crisis. So I was right next door to that.
A dubious honor. That's tough.
Yes.
And from those humble beginnings, talk us through your introduction to the financial markets. Was it through school? Was it through an employment experience? How did you learn about the markets?
As far as the markets go, my first experience was actually with my mother. In the late 70s, early 80s, we used to spread out what was then the local newspaper, the Worcester Telegram and Gazette. We'd spread it out on the kitchen floor and we would pick stocks together. And of course, given the time frame at the time, you can imagine most of what we were buying was gold stocks and things like that. So, that was, a good indication early on that I had a trend following interest, but the fact that I still own some of those certificates today tells you that in the early going, I didn't do so well with risk management. so I kept the certificates as a reminder that you gotta have an exit plan. So
that's fantastic. And did your mother have a financial background, or was she just an individual investor?
Oh, wow. Not at all. She's super passionate about it. Whenever I go over to visit her house, one of her favorite things to do was play cribbage. And we would play cribbage for hours. And in the background would be CNBC. And she'd be simultaneously harassing me in our cribbage game and then making comments about what she's hearing on CNBC. So she's pretty passionate about it.
I love it.
Yeah.
So then talk us through when your career gets started. Did you study finance or something like that in college? How did you?
I did. I studied finance and investments at Babson College.
Right.
And my first job out of college was actually up in Canada, where my wife to be actually was still finishing out her school. So I went up there I planned to go up there for an eternity, having nothing to do with, of course, being married, but going up there just to move up there and stay there. And my first job there was a stockbroker, actually.
Got it.
And it turns out that the gentleman who I sat next to in Dean Witter, his name was Kuldeep Raheel, and he managed a pretty sizable book back then, and he relied heavily on technical analysis, which I had up until this moment. The only experience I had with technical analysis was my professors at Babson telling me that it was useless and didn't work, and spent all of 3 seconds on it, and which is no different today than it was back then. But
that's right.
My son, I was teaching the technical analysis course at Brandeis, which I took over from you, which was a great experience. And I was in the middle of teaching one of the classes, and I got a text from my son Eric, who was at the time he was out at Colorado University, and he was in his investments class, and he said, "Hey, Dad, we just covered technical analysis. It took about 5 minutes, and the professor says it's BS." So So, things, the more things change, the more they stay the same. So, so that's still the I guess the academic mantra that it doesn't work, and they've got a vested interest for saying that that's the case. But at any rate, what I saw in the early part of my career was somebody really using technical analysis the right way. And as soon as I saw him, generate ideas, manage risk, it was just, I was hooked from that moment forward. And once I came back to the US, my first job when I came back to the US was a technical analyst. And I've been either a technical analyst or a portfolio manager using technicals ever since.
That's fantastic. So when you came back to the US, was that Fidelity, or was that a different spot then?
That was a company at the time called Technical Data, which
Oh, that's right.
All this stuff changed after I sort of left, but it ended up being part of Reuters, vis-a-vis
Oh,
Thomson
right.
Financial, vis-a-vis Thomson, and so that was my first job, and it was not too late in the history of markets. Of course, it was like 1990, I think it was, but back then we were still maintaining some charts by hand. So one of my jobs, the actual job was called updater. And one of my jobs was to update the point and figure chart of the bond futures contract up on the wall
Right.
every day, and then manually input the hourly ranges of the bond futures contract, because we would then update that and then send it to the Telerate system back then,
Wow.
which is now no longer in existence. That was usurped by Bloomberg, which when it first came out, I looked at it and said, this is never going to work. And of course, it's Bloomberg is what it is today.
Worked okay.
So that's a lesson learned, right? Stick to your knitting.
Oh, it's funny. It reminds me when you're talking about the updater role. It reminds me when we've talked with Ralph Acampora. He talks about early in his career, you were called a chartist because most of your time was spent charting. You're actually producing the charts, and the analysis was that stuff you did at the end, but actually creating them and maintaining them, right, was a whole.
Well, the analysis was the stuff that the senior people did.
That's right. That's right. You're the updater. You're preparing it for the other guy, right?
Exactly.
So what year was that when you were up in Canada, sort of first being introduced to technical analysis? About what year or what time?
So I got married in '89. So my first job was with Dean Witter in 1989, and 2 or 3 months after I started, we had the mini crash in 1989, if you remember that. Yes. So in any like in isolation of all other time periods, that crash would have been considered to be horrific and very alarming. But of course, it happened 2 years after the '87 crash, so that's why we call it the mini crash. Right. But it was a pretty serious slide, and it was kind of an ominous way to start your career. So one of the things I've noted is that if you do a chart of the market since I got in, and you point to all the points along that chart where I've made a career change, every career change I've ever made has happened at a major turning point in the market. So I'm just giving you the heads up. I mean, I just left Wellington in December, so I'm just saying.
I'm immediately thinking about the current market environment for that, David. But no, so it's interesting because you talk about getting started in sort of '89. That a lot of people think about the '87 crash. They immediately kind of fast forward to the 2000 tech bubble as like the next thing. But I think during your formative years, you had '89. You also had like '94. There's some pain in there. I mean, there's some choppy periods during the '90s that it wasn't just point A to point B. I mean, there's some. Tell me about those. I mean, what did you learn about risk management, about opportunity? What did those years mean for you as you're learning the toolkit?
Well, one of the things you highlight was the '94 bear market.
Yeah.
And if you use the traditional definition of a bear market, which is down 20%. That particular year, I think it was down 9%, 9.8% or something like that, close to close as the worst case scenario. So that would not pass muster by anybody's definition if you're holding to that 20% definition. But if you actually look beneath the surface, that was a horrific bear market. If you look at the advanced decline line, that was a meaningful bear market, and it had a lot to do with what happened with interest rates. So what I learned then was that the index often lies. It conceals the truth, and so it's important to do top-down work, but you have to do bottom-up work to connect the dots. And oftentimes you'll learn a lot more about what's actually happening within the market by doing that bottom-up work. And today is like a perfect case in point for that. Yeah.
Yep. Yeah. And it's funny, and we often think of, I think that definition of a bear market is very misleading, right? When you think it's because people think of the '87 crash as like a bear market, or 2007 to 2009. That's what a bear market is. But a market can correct and it can transition in a lot of ways that are a lot more painful than the chart of the S&P might imply, right?
Right.
That's really, really interesting. So tell me about then, soon after then, the period we were talking about then, as you came back and worked for, it was Technical Data. From there, what was next? And I know you've spent time at, some of the largest buy-side institutions that, explicitly use technical analysis. Talk about your career path from there.
Well, my career path went from Technical Data to Fidelity.
Okay.
So at the time I was also at Technical Data. I was also, believe it or not, I was reporting from the Boston Stock Exchange floor every morning.
That's awesome.
which is kind of, it's, the exchange is gone. I mean, it doesn't even exist anymore. So, but that was a lot of fun. And I unfortunately had to give that up when I went to Fidelity, as you know, Dave, because having worked there yourself, you can't report from the Boston Stock Exchange floor and work at Fidelity at the same time. So it was an easy decision. So I made that transition, and I was on the technical research team from 99 to 02.
Yeah.
And that was, of course, an incredible experience. I mean, that's really where my analysis transitioned from predominantly futures and the S&P index and the 10-year treasury and Eurodollars and FX and things like that, which is what I really focused on at Tech Data. That's when I transitioned really to equities.
Right.
And so my primary focus has been equities since then.
Right. And then after your time at Fidelity, then you rotated, I think there was a hedge fund experience there. Tell us about the next steps.
Yeah, a number of us from Fidelity left Fidelity to start a hedge fund.
Right.
And that was another, it's funny that when you take chances, you can pretty much rest assured you're going to learn things.
Yeah.
But sometimes you learn things you weren't in areas you weren't expecting. And so that was, of all the experiences I've had in my career, that was probably the most formative for me, just because the team that we started the fund with, very, very talented team. The lead manager was, and to this day, I would consider him to be one of the best portfolio managers and stock pickers I've ever worked with. But we just noticed, there's a lot to be said for the impact of behavioral bias on the whole process, right? And no matter how good you are, you're exposed to it. And so that was my learning lesson there, was to see how powerful things that have nothing to do with investing can influence you to do things that, in a more like a vacuum type of a world where you had no influences like that, none of those things would come up. So ever since then, I've just been very, very mindful of, like, always listening to myself talk. Like, when I say something, just be aware that I just said that, because oftentimes what you're saying in your mind, certainly the market doesn't know, the market doesn't care, but it has an awful lot of influence on you as an investor and how you behave. So that whole process, I managed a slice of the fund, did really well on my slice of the fund. But that was my biggest sort of awakening to the importance of self-awareness. Everybody's fallible, no matter how good you think you are. As soon as you think you figured it out, that's when you really need to be concerned that the other shoe is about to drop, that kind of thing. So but so I decided from there to actually launch my own research firm, which I had for about 3 years. And through that process, I created a bunch of models that I still use to this day, and they were sort of foundational to the research product that I developed. And that's how I came to get to know Frank Texera better than I had known him from my Fidelity days. We had met a couple of times, but we didn't know each other too well. But through my research product, he became a client. And after a number of years of him asking me to shut everything down and come join his team, I finally decided to acquiesce and close down my shop. And I was at Wellington from 07, which you'll note was a major turning point. I joined Wellington pretty bearish, actually, because again, the S&P was saying one thing, but the internals were saying something quite different.
That's right.
The number of primary timeframe tops in the consumer discretionary space, and of course, financials were just doing terribly. Basically, by the end of that move, which is very traditional, very classic, by the end of that move, the only thing that was working was energy.
Yeah.
And that was the leadership for that bull market. And so when I joined Wellington, I was pretty bearish to start. And, I just finished up about a 13-year career there just this past December.
It's an incredible run. Now, tell me this, because now as you've described your career path, you've sort of done a good mix of both. You've a part of your job has been a storyteller, to put to clarify, right?
Absolutely,
Sort
yeah.
of describing the markets, illuminating the markets. And the other thing, which is a very different skill set, is actually trying to make money using charts. Can you talk about the differences of applying technical analysis, or is it all the same to you and just a different way that you're a different output of it?
It's funny, on our podcast, which we do with the CMT Association, we had interviewed Walter Deemer, and I had asked him that question, and I said, what distinguishes a PM portfolio manager from an analyst? And he said that to be a portfolio manager, you need to have ice in your veins. Right. And I think that is the difference. And I'm not saying that I do necessarily have ice in my veins, but it's important to be able to weather the storm and endure the pressures of managing money, especially if it's not just your money, if it's somebody else's money and everybody can see your performance. And it's again, it has nothing to do with investing per se, but it has everything to do with performance, because you have all these other stresses that come into your decision making that actually have nothing to do with the analysis. So that's why I think you can find some really incredibly talented technicians out there who can actually really truly help a portfolio manager manage a portfolio, because they're not managing money. There's actually value in finding a good technician who doesn't manage money, because they'll give you the most pure read on what's happening that sometimes you struggle to see because you have all these other things sort of filtering your view.
Yeah. Oh, there's so many great things you mentioned in there. You had mentioned the podcast for the CMT Association, the Fill the Gap podcast, which I'd certainly encourage everyone to check out. It's really well done. Can you talk about the CMT Association, which has become, over time, I think more and more part of what you've spent your time on? What drove your involvement in that organization? What has that meant for you so far to be involved there?
It's really an opportunity for me to find a home to really go after my lifelong goal, which is to advocate for technical analysis, because I've been doing it for so long, and the organization is just right out there at front and center, trying to accomplish the same thing. And they've just done an incredible job. And what they've done in the past 10 years in terms of really ramping up their testing process and the quality of the testing and their support for the CMT charter holders and things like that, it's just really incredible. So I'm personally very honored to be a part of it. It turns out I'm on the board of directors right now, but within that, I'm also the head of the advocacy committee, which is, so that's hence the podcast, right? So the whole purpose of the podcast is to shine light on the value of technical analysis, the CMT Association itself, but then really what I want to do, and so this is my veiled invite to you, Dave, is to bring people onto the podcast who have their CMT, who are thriving one way or another, either managing money or as an analyst, right? And bring we're the folks we brought on so far are some of the more marquee names. We have Jeff DeGraff is coming out this month in April. Then we have Frank Texera is coming out after that, and then we have others that we want to just start to really build out a list of guests that come from that have the commonality is technical analysis, but I want to bring them in from portfolio management, analysts, content providers. One of the things you do a great job with, and Jeff DeGraff does a great job, and I think I've seen others as well, but they just do a great job with data visualization. I think that's one of the next frontiers of technical analysis, right? That's what technical analysis has always been, is data visualization. But now we have opportunities to really take that same core tenet of what we do, which is look at charts and look at them differently and to glean different insights. And so if we can bring in guests from that perspective as well, I think, at the end of the day, it's to add value to the technical community. I think that's an important way to do it.
And you mentioned Walter Deemer and Bob Farrell. That was a fantastic discussion.
That was incredible.
Rare treat.
Yeah.
You mentioned earlier in our conversation your time teaching at Brandeis, and I had taken over that course from Charlie Kirkpatrick. enjoyed teaching that for a couple of years. I asked you to take over for me, and you did much better than I had ever hoped to do. Educating the people around you. Can you talk? Did you learn anything from your time teaching the students at Brandeis?
So first of all, I have to tell you, thank you very much for that, for tapping me on the shoulder to take over for you, because it was a great honor for me to do it. And what it ended up doing, and I'm sure you can say the same, is that it was an opportunity every semester to just reground myself in basic principles.
Yeah.
Because the one of the great strengths of technical analysis is all the tools we have, but that's also one of the weaknesses, is we have a lot of tools. And so you can, and they're all back testable. You can determine which ones add value and whatnot. But at the end of the day, you still have to get to the core principles of what you're trying to accomplish before you start to try to sort of improve upon your analysis with these other indicators. So it's always returning yourself back to the basics. And through that process, I think it's made me a better portfolio manager and a better idea generator and a better risk manager, just by making sure that I'm not deviating too far from price itself.
Yeah.
And at the end of the day, the questions that I was asked were just really, one of the best ways to learn is to teach. And in the process of having to go back and kind of, again, reroute yourself and reground yourself in those basic principles to re-explain them again and again, it just really embeds it further and further in your psyche, so that when you're sitting there executing in actuality, you have these things more front and center, if you will, as you're executing in a portfolio.
Yeah. It's
Yeah.
beautifully said. Tell me this, what mistake in your career has taught you the most?
Well, I can tell you that I'm very risk aware, almost to a fault, like to the point where it causes me opportunities.
Yeah.
So I've never made big mistakes. So like I've never lost a lot of money. I've had years where the market went up a lot more than I did, but I've never lost a lot of money.
Yeah.
So mine's more like death by 1,000 cuts. I've never made a massive mistake. And if you think about like the end result of your portfolio, or the performance of your portfolio is just the expectancy formula, right?
Yeah.
How often are you right, and how much do you make when you're right? Yeah. How often are you wrong, and how much do you lose when you're wrong? It's simple math. Put it together. If it's a positive number, wash, rinse, repeat. You should do that forever and ever. Yeah. So when I look at that formula, and I just I can't recommend this enough to your listeners and viewers to do this with your portfolio. Take all of your trades you've done and find out what your expectancy formula looks like, because it'll give you a tremendous amount of feedback. And so if I think about mistakes that I've made, it's not always mistakes that cost you money. It could be mistakes where you lose on the upside, right? So in that expectancy formula, where I have had some, like I was long Bitcoin from 350 to 20,000, which was a great trade, but that was a good example of a mistake I made. It should have been way bigger, right? But the reality is, mistakes are important to learn from as much as you can. You definitely should do that. But what I've always felt is that this is a regret business. No matter what, you're going to regret, right? So if you bought it and it went up a lot, you regret not buying more.
Yes.
If you bought it and it goes down, you regret buying it at all, right? So you're always going to regret whatever decision you make. So you got to be careful of that, right? So as you're trying to learn from your mistakes, just be mindful. Don't be too hard on yourself, because nobody's perfect and whatnot. So for me, it's always been, and I think Frank Texera would probably agree with this, because he's the opposite of me in this regard, is that when my process is really aligned and I can tell him that things are going to work out well, I don't make big enough bets. But that's just my personality. I'm working on it, and we'll see how it goes. But as I'm trying to feel my way through that darkness, I can just say that I, in the interim, should not lose a lot of money. So that's keeps me at the table.
So we just have time for one brief question, David, and it's this: do you have a favorite quote or saying about investing for someone just getting started they should keep in mind as they begin their own journey in the investment landscape?
Well, so I mean, it's funny, like the number of people that, when asked to quote somebody, the number of people that say something from Jesse Livermore is incredible.
Yep.
because it's almost like annoying because everybody goes to Jesse Livermore. So on the one hand, it's annoying, but on the other hand, the fact that most of what he said over 100 years ago,
Yep.
and everything he said is still as relevant today as
Still
it was back then,
ranking.
that's actually the thing we should be mindful of, right? That just goes to underscore the idea that things haven't really changed. That's why, you know, your process should be as simple as possible and don't overcomplicate it, and because nothing's really changed. So I'm going to be that guy, and I'm going to quote Jesse Livermore, but I have it written down here because it's a bit of a longer one. But it's when you're doing nothing, those speculators who feel they must trade day in and day out are laying the foundation for your next venture. You will reap benefits from their mistakes, and I think that's an important thing to think about. And it actually goes back to what Charles Dow talked about with the Dow theory, where he broke the market down into 3 time frames: the ripples, the waves, and the tides. Long term, short, medium term, and short term. And it's why he tended to stay in that primary time frame analysis, which is where I stay as well, because all the mistakes are made in that short term time frame. And so let that play out. Don't over weight what happens on any given day, and just always try to reflect back on that monthly chart. You know, I know JC Peretz likes to say on Twitter, when it's the end of the month, he puts out a tweet saying, "It's the end of the month. It's my favorite time of the month because you get to look at the monthly charts." I'm the same, but I actually today was a really important day for me, because today was not just the opportunity to look at monthly charts, but it was also quarterly charts.
Right.
You know,
Right.
and so that's the time frame I try to stay in. And I think the reason is because and again, Charles Dow said this, those short-term time frames are driven by emotions. And because it's emotional, that's where all the mistakes are made. So let those mistakes play out, let other people do them, and you just stay focused on the time frame that matters most to you, which is that primary, fundamentally driven time frame. And you know, hold your breath, and hopefully everything works out okay.
Something I hope everyone keeps in mind for right about now in uncertain times. Dave,
Exactly.
this was awesome. This was so fantastic. I appreciate, I feel like you have so much to share, and you've done so through Brandeis, through the CMT Association, through a lot of the stuff you've done in the industry. So thanks again for joining us today. Appreciate it.
My pleasure, David. Thanks for everything you're doing. What you're doing with StockCharts is incredible. Watch all your videos, and really appreciate the opportunity to join you today.
Thanks, Dave.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.